Hey everybody, it's David Duford at the Dig Agency. Today we're going to be doing a practice exam over the types of life insurance policies that are out there. So this video is perfect for you if you are attempting to pass the life and health exam at a future date and you want to run through a real life example of test questions that you'll most likely have to experience. So what I'm going to do, and what makes this video different from some of the other training that's out there, is I'm going to not focus so much on learning the concepts as to helping you give tips and tricks to remember what these definitions mean. So when you're in the test, you'll have the tools necessary and the recall rate that you can say, oh, I remember Dave said this and that means that. And that hopefully will help give you a little bit more edge in passing the exam, so that you don't have to fool around with this and can get to work, make some sales, and sell insurance and help people. So let's jump right in. Which type of life insurance provides coverage for a specified period? Is it A, variable life, B, universal life, C, term life, or D, whole life? Well, the answer is term life. And the best way to think about this is that term is for a term of time. So you think about the terms and conditions, right? So typically a term is for a specific period of time. Whereas if you look at the other answers, whole life insurance, last year, whole life. A term typically isn't a whole, it's a portion of a whole. So in this case, a specified period of time, you can think of it as a term of time. Does that make sense? Whereas a variable, it's variable, kind of refers more to the premiums, and universal doesn't really tell you exactly. But in the name of term, think for a specified period of time, because you'll see that definitely show up. And that's the explanation, if you'd like, on what term insurance is. Okay, what distinguishes level term life insurance from other term variations? Okay, so the difference here is level. Let's remember that as we go in. A, premium decrease over time. B, death benefit remains constant throughout the term. C, coverage automatically converts to permanent. Or D, it builds cash value like whole life. The answer is D or B, death benefit remains constant throughout the term. So when you hear level term, level typically refers to the amount of coverage, also known as the death benefit, that the beneficiary, the person receiving the money, gets after the insured person who you took the policy out dies, right? So if you have a level term, then that death benefit remains the same, because there are plans that do decrease over time. Those are called decreasing term insurance. Obviously, if it decreases, it's not level, right? There's an action downward. So level always refers to, in this case, when you see it, level term insurance, to the amount of coverage stays constant throughout the term of the policy. Level term keeps both the premium and death benefit fixed for the entire term, providing predictable costs and coverage, unlike decreasing term, where the benefit drops. Number 3, in decreasing term life insurance, what happens to the death benefit over time? It increases to match inflation. It stays level while the premium decreases. It reduces gradually, often aligning with the loan balance. And D, it converts to cash value. The answer is C, it reduces gradually, often aligning with the loan balance. And the reason that is because, again, just like the opposite of what we just talked about, level term insurance, at level death benefit, well, now that term is now, or that word is now decreasing. So it still refers to death benefit, but it's going down over time, right? It's decreasing the amount of coverage. So in this case, it reduces gradually, typically like with a mortgage or something like that. Which term life insurance subtype allows the policy to be renewed without a medical exam, a new medical exam? A, convertible term. B, renewable term. C, increasing term. Or D, group term? The answer is B, renewable term. And what that means is that renewable term permits extension at the end of the initial term without proving insurability. But premiums rise based on the attained age, providing flexibility for those whose needs extend unexpectedly. What is a key feature of convertible term life insurance? Again, convertible term life insurance. A, premiums decrease annually. B, allow switching to permanent coverage without medical underwriting. C, death benefit increases over time. Or D, it's only available through employers. The answer is B, allow switching to permanent coverage without medical underwriting. So again, if you think about it like you're converting something, convert means change, right? So I'm changing the term insurance to something different. In this case, we can change it to what's called a permanent policy. And those are policies like whole life insurance. That's the most common conversion option. Sometimes it's universal life. Before the term ends, bypassing new health checks, which is crucial if conditions worsen. So again, convertible means changing it from term to a permanent policy. Which permanent life insurance type offers lifelong coverage with fixed premiums? Is it whole life? A. B. Term life. C. Universal life. Or D. Variable universal life. The answer is A. Whole life. And the reason that it is A. Whole life is because whole life insurance provides coverage for your entire life. So again, the key thing here in the question is lifelong coverage. Whole life is lifelong coverage by default. Remember, term lasts for a term. It terminates at some point in the future. And universal can be designed that way, but it's also flexible in how it's designed. So it can act like a term insurance policy or act like a whole life. So it's not guaranteed like whole life is. And same thing, variable universal life is a variation of universal, so it follows the same parameters. So the point being is that whole life insurance has level premiums. Okay, so again, that is another fixture of whole life. For the whole life, it's lifelong and has level premiums, which mean the premiums never increase. Term insurance is not lifelong, so we wouldn't answer that at all. And universal may or may not be, as well as the premiums may or may not be level either. So these are kind of like up in the air type of questions, and variable universal life fits into the universal life bucket. So whole life is the only one in this case that answers the two main things concerned, lifelong coverage and fixed premiums. What characterizes ordinary whole life insurance? Premiums paid in a lump sum. Coverage ends at age 100. C, premiums paid continuously until death or maturity. Or D, flexible premiums based on interest rates. The answer is C, premiums are paid continuously until death or maturity. Again, the whole life descriptor tells everything. Again, when you see anything that is for life or forever until they die, typically that's whole life insurance. Premiums paid continuously until death or maturity. Ordinary whole life, also called straight life, requires premiums until age death or age 100 or 121. When it matures as an endowment and it builds cash value steadily. Again, whole life doesn't end at age 100. You may stop paying the premiums at age 100. That's called the endowment of the policy. But the policy is still in effect. Okay. And limited payment whole life insurance. Again, limited payment. How are premiums structured? A, paid over the insured's entire lifetime. B, paid in a single lump sum or for a set number of years. C, adjusted annually based on performance. Or D, waived after the first year. The answer is B. Now remember, limited payment. So we're talking about the payment. And it's whole life insurance, right? So in this case, typically whole life insurance you pay till you die. But that's the ordinary life insurance we were just talking about, till the endowment date. But in this case, a limited payment says, hey, this is whole life insurance. The premiums are fixed, but instead of paying your whole life, we're going to limit the number of payments over a set number of period of time. And then you stop paying it not necessarily endows, but it gets to the point where you don't have to pay it anymore. Okay. Limited payment whole life front loads premiums into a finite period, typically 10 years, 20 years, or you pay until age 65. But coverage lasts for life with faster cash value growth due to higher payments. What defines single premium whole life insurance? One upfront lump sum payment funds lifelong coverage. B, premiums increase each year. C, coverage only for 1 year. Or D, premiums tied to stock market returns. The answer is A, one upfront lump sum payment funds lifelong coverage. Again, single premium, think about it like this. It's whole life insurance. It lasts your whole life, right? But there's a single premium payment. So in this case, it's a one-time payment. You pay it up front, and that's it, and you now have lifelong coverage for the rest of your life. Which flexible permanent policy allows adjustments to premiums and death benefits? Is it A, whole life insurance, B, term life insurance, C, universal life insurance, or D, endowment life? The answer is C, universal life insurance. So again, we can do a process of elimination here. We already know, going through these questions, that whole life lasts your whole life, right? And then the premiums are fixed. Well, this one is saying, the question says, allows adjustments to premiums and death benefits. Well, the death benefit's fixed. Excuse me, let me take that back. The premium is fixed. So we know by default it can't be whole life insurance because you can't adjust the premium. So scratch that off. Now, term insurance, you can't adjust the premiums. The death benefit is level in many cases. And again, this allows it to happen. Whereas if you have a decreasing term, it's prescribed or pre-prescribed or pre-designed in the policy. You can't adjust that. What this is asking is, what can you adjust based off of adjusting the premiums or the death benefit? So in this case, it ends up being either C or D, and endowment life is basically whole life in a sense. So it just ends up being universal life insurance. So universal life separates insurance from savings, letting you tweak premiums, benefits, and cash value based on interest credited rates with transparency via annual reports. What is an index universal life insurance policy? Is it a policy with cash value tied to fixed interest rates? Is it a B, no cash value accumulation? Is it C, is it only for 5 years? Or is it D, cash value linked to stock market indices with downside protection? The answer is D. It's a cash value policy linked to stock market indices with downside protection. So in short, index universal life. So it's a universal life plan. So we know that the premiums can be altered and that the death benefit can be as well. The difference with a universal life plan, and whenever you see indexes, think stock market index, think stock market, okay? And the idea behind it is that it allows upside growth potential with sometimes caps on gains. Typically there's caps, but the big benefit of it is that you can't lose money when the stock market tanks. So there's these floors on it against losses. So it's a way to sell growth or participation when things are great in the stock market, but without the downside risks. In variable life insurance, where is the cash value invested? Is it invested in sub-accounts similar to mutual funds, in guaranteed fixed accounts, directly in real estate, or D, only in government bonds? The answer is A, in sub-accounts similar to mutual funds. So the thing to remember about variable life insurance is always look for the sub-account definition. Typically, that's what you find on the examination. And the idea is that it allows you to participate in these very much like investment grade type options. And they can be different things. It's not just stocks, it could be bonds, it could be other things. And it's definitely, looking at the other answer, it's not directly in real estate or directly in government bonds. And it's not guaranteed either. It's a variable. There's risk associated with it. Variable life lets policyholders allocate cash value to investment sub-accounts linked to stock or bond funds, with death benefits varying based on performance, but guaranteed minimum. What combines features of universal and variable life insurance? Is it a term life insurance, whole life insurance, variable universal life, or D, decreasing term? So the answer here is C, it's variable universal life. And so VUL, we call that for short, offers flexible premiums and adjustable benefits like universal life, but with cash value and investment sub-accounts like variable life, allowing control over growth and risk. Which policy types pay a benefit at the earlier of death or a specified maturity date? Is it term life, endowment insurance, universal life, or renewable term? The answer here is endowment insurance. And endowment policies mature after a set period, typically 20 years or at age 65, paying the face amount if you survive, or death benefit if not, with rapid cash value buildup. 15, what is joint life insurance designed to cover? A, only one individual. B, 2 or more lives. C, permanent needs for groups. Or D, temporary needs for groups. So the answer here is 2 or more lives, and the reason being is, remember, joint is the key word, joint. You're combining 2 things together. That's what a joint is in this case, okay? So when you conjoin 2 people to be covered, then you have joint life insurance. Now, it can be first to die, so dependent on the first person to die, and then it pays out. Or it could be a survivorship policy where it pays out after the last of the group dies. And it insures multiple people under one policy, payout on the first death, in a first to die policy. Survivorship is the last to die. Often cheaper than separate policies for couples, shared needs, typically like mortgages. Again, joint means 2 or more. Think of 2 things you can join. Conjoin twins, right? 2 things connected together. Same idea here. And survivorship life insurance, when is the death benefit paid? Upon the first insured's death. B, annually as dividends. C, only if both die simultaneously. Or D, upon the second or last insured's death. Well, if you listen to the last answer I gave you, it's D, upon the second or last insured's death. So remember, it's the survivor. Think about survivor like the last person left, right? So this is after everyone else is dead in the policy. This is the last person that's left. And then when that person dies, then it pays out to whoever it goes to. So survivorship, second to die or last to die, covers 2 lives benefiting on the latter death, ideal for estate taxes as it aligns with an inheritance transfer. What differentiates group life insurance from individual policies? A, it's issued to one person with medical exams. B, covers a group, like employees, under one master policy. C, always permanent with cash value. Or D, higher premiums for better coverage. The answer is B, covers a group under one master policy. And the idea, the dead giveaway here, is that it's group insurance, right? It covers a group of people, typically in a corporate setting with multiple lives of employees. Sometimes you see it in nonprofit ventures as well. One of the other elements that is important to understand with group life insurance is that the rating class tends to be as a whole, which lowers costs, and up to a certain amount will be no examination or underwriting necessary. Now, if the employee opts to get more, then there's typically some underwriting up to a degree. Which policy type is often used for key person insurance in businesses? Is it annuities? B, term, whole, or universal life? C, endowment for short terms? Or D, variable life or investment? The answer is B, term, whole, or universal life. So a key person policy, just to remind you, think about the key person in a company. So you've got a famous person, or you've got a company where the operations manager is so critical to the functioning of the company that if that person dies, the owner and everybody else knows that companies go through a lot of hard times, right? Think about Steve Jobs, right, at Apple. He was the key person for Apple. And the idea behind key person life insurance is that it covers that key person and pays a death benefit to the company to help with hiring, maybe provide funding to get through some of the tumultuousness that will happen post-death because that leader isn't in that position. So the idea behind it is to ensure the company to have some level of continuity and protection from financial problems that would ensue from that key person dying. What is a modified endowment contract, a MEC? A term policy converted to whole life. B, a life policy failing the 7-pay test, tax like annuities. C, a group policy for endowments. Or D, a policy with decreasing premiums. The answer is B. And the best thing to remember about MEC is that you will see this 7-pay indicator in the test question. MEC status hits if premiums exceed limits in the first 7 years. So you'll see premiums exceed limits. That's another thing. And it's a 7-year test that they use. Losing tax advantages on loans and withdrawals. Taxed first in, first out. And the last question today, which life insurance type is best for someone seeking a high growth potential with market-linked returns? Is it level term, B, whole life, C, variable universal life, or D, decreasing term? The answer is C, variable universal life. VUL ties cash value to investments, offering upside with flexibility, but no guarantees, suiting risk-tolerant individuals aiming for wealth accumulation alongside protection. I hope you enjoyed this practice test. We have more if you want to check the chat below. We have playlists. We also have free walkthroughs that will help you test and be prepared. These are just explanatory videos that myself or Chris Jaffe has done, and these will help prepare you to pass the life and health insurance exam. And I want you to remember one thing before you go. After reviewing some of our other content, if you're looking for an agency to join, that's what we do at the Dig Agency. Most of our agents are brand new to the industry, and they work with us because we provide free leads. We have great, amazing sales training. There's no multi-level marketing training or anything like that, like a lot of the other guys. And the whole idea is to provide you an opportunity to sell predominantly life insurance from the comfort of your home remotely. So if you want more information on that, davidduford.com is where to go. You can also find all the links below for everything I've said. And again, thank you for the opportunity for helping you out, and good luck on the exam.